We're now going to look at the Ponzi scheme and the tax deductions that result from losing money in a Ponzi scheme. The Ponzi scheme is a theft. The theft is a word of general and broad connotation covering any criminal appropriation of another's property to the use of the taker, including theft by swindling, false pretenses, and any other form of guile. The taxpayer claiming a theft loss must prove that the loss resulted from a taking of property that was illegal under the law of the jurisdiction in which it occurred and was done with criminal intent. However, the taxpayer does not need to show a conviction for theft. So what do we have in the typical Ponzi scheme? We have a person, usually of very high repute, who has started an investment scheme. The investment scheme never was intended to show profits. The investment scheme promised large profits. People invested looking for large profits, and instead of receiving large profits, they were faced with one big theft loss. And that theft loss is considered by the United States, by the Internal Revenue Service, because it was a loss that was a result of trying to be involved in a profit-making activity, is a loss that, under the Trump tax bill, is still deductible on a going-forward basis, while many, many of the non-business theft losses and casualty losses have been done away with by the Trump tax bill. The theft loss resulting from a Ponzi scheme is the initial amount invested in the Ponzi arrangement and any additional investments upon which taxes have been paid, less any amounts that the taxpayer withdrew for the taxpayer's benefit. The IRS agrees that if an amount is reported to the investor as income in years prior to the year the Ponzi scheme theft is discovered, that the investor can include the amount in gross income, then the amount of the theft loss is increased by the purportedly reinvested amounts that taxes were paid on and yet were left there in the Ponzi scheme in hopes of having even bigger profits when there was only false profits. Now, it's very important to be precise here when we're talking about Ponzi schemes. And the first thing of precision is, what is the year of discovery? Because the year of discovery determines exactly when the whole thing is put in play that is going to lead to refunds for monies lost in Ponzi schemes. The definition of the year of discovery is as follows. Any loss arising from theft shall be treated as sustained during the taxable year in which the taxpayer discovers the loss. The loss is considered discovered when a reasonable person in similar circumstances would have realized that he or she had suffered an unrecoverable loss. Although a theft loss must be considered as sustained in the year of discovery, that does not mean that discovery of some false representation creates a theft loss as of the date of the false representation. The statute talks about the year of discovery of the loss, not the year of discovery of the theft. The year of discovery is very important in the case of Ponzi schemes, and it's critical to show here exactly when and how a taxpayer can pin down this time. So we're going to look at the amount and the timing of a theft loss. The theft loss definition, theft loss must be postponed to the extent that there is a reasonable prospect of recovery. So you can have a theft loss in a particular year And if it looks like you're going to recover a lot of that theft loss, you're not going to be able to take a deduction for the theft loss. The deduction that you can take is depending upon the reasonable prospect of recovery. Theft loss deductions cannot be taken and must be postponed if there is a reasonable prospect of recovery. A reasonable prospect of recovery exists when the taxpayer has a bona fide claim for recruitment from third parties or otherwise, when there is a substantial possibility that the claims will be decided in the taxpayer's favor. The taxpayer is not required to be an incorrigible optimist, and claims with only a remote or nebulous potential for success will not postpone the deduction. In determining the reasonableness of a taxpayer's belief of loss, the courts had to be practical and aware of individual facts of each case. Circumstances are those that are known or reasonably could be known at the end of the tax year for which the loss deduction is claimed. The only test is foresight, not hindsight. The objective and subjective factors must be examined to determine what is the amount of the reasonable loss suffered in a particular year by the taxpayer. The taxpayer's legal rights as of the end of this discovery year are all important. One of the facts and circumstances deserving consideration are the probabilities of success on claims brought by the taxpayer. Just because a taxpayer files a lawsuit, that doesn't mean that there is a reasonable prospect of recovery. The inquiry is directed to the probability of recovery as opposed to the mere possibility. If there's a remote possibility of recovery, then it's not enough. There must be a reasonable prospect of recovery at the time the deduction was claimed to put off the amount of the deduction. Now, the Internal Revenue Service in the year 2009, right after the Madoff debacle, which was really the start of formulating the basic rules that had been all over the place when it came to financial theft loss in the past, the Internal Revenue Service put out two documents that were very helpful. The one document was in the form of what we call a revenue ruling. That revenue ruling is Revenue Ruling 2009-9. A revenue ruling is where the Internal Revenue Service lays out the basic law that governs a particular situation and provides guidance on interpretation of that law. The Internal Revenue Service also provided another document. The other document was intended to make sure people that lost money as a result of their investments in Ponzi schemes would not have to go through each and every person filing their own different kinds of tax returns, claiming different years, claiming different amounts, taking different positions. The Internal Revenue Service wanted to make it for certain people that suffer from Ponzi scheme losses, from clear-cut Ponzi scheme losses. They provided a publication called The Safe Harbor. Now, basically, what's a safe harbor for tax terms? The safe harbor is where there's a Ponzi scheme, and everything about it is pretty clear. It's clear that there's a perpetrator of a Ponzi scheme, and the perpetrator was a bad guy, liable to be go to prison. Number one. The next thing is it was clear that what the amount of losses were. The amount of losses were going to be the invested capital and all of the profits that were reported and reinvested that were lost. So if you had $1 million investment in Madoff, if you made $1 million over the years and never took any of it out, you had a $2 million loss. And since Madoff did go to prison, you had a perpetrator that caused that loss and that the IRS was sure was a theft. Now, these two documents, we'll look at them and what they have to say as we walk through this. The last item we will discuss is the safe harbor, what the safe harbor does for people, what requirements have to be met for the safe harbor, so that you can take a very simple approach to filing tax returns and seeking recoveries when you lose money in a Ponzi scheme. When you have a theft loss, you do have two choices in certain circumstances. You can claim the theft loss as a deduction, and you have to determine the appropriate year for the theft loss and the appropriate amount of loss that you think you are going to have in the initial year. And then as the years unfold, if there's additional losses, if you thought you were going to get back 50 cents on a dollar because of a lawsuit, you would only claim 50% of your loss in the year that you've discovered it. And you would need to have to wait until the later years to actually deduct those losses. Now, there is a little window where you can either take a deduction, with that deduction, follow the rules that allow you to, in the past, go back for 3 years if you had a theft loss, a financial theft loss, and amend your returns and go forward for 20 years. That's changed. Now there's not going back, but going forward only, and there is no limit to how many years one can go forward. There still is the opportunity, if you've had a Ponzi scheme theft loss and you want to file amended tax returns because the statute of limitations is still open, and you want to go back and claim the losses, this is in years prior to the Trump tax bill, if you want to go back and claim the losses from these prior years, which may provide you with a more valuable tax deduction, you were permitted to file amended returns as opposed to filing for a deduction only in the loss year and then claiming loss carrybacks and loss carry forwards. It's pretty much going to be a thing of the past, though, as we move on in years. Now, tax refunds from Ponzi scheme losses are extremely valuable, and the higher the tax bracket you're in when you're claiming those deductions, the more valuable they are. So let's just summarize what happens in a typical Ponzi scheme. A financial theft occurs. In the year the loss is discovered, a business deduction can be claimed. However, the deduction that's claimed in the year of discovery might be limited if there is a reasonable prospect of recovery. The taxpayer who has lost money needs to make an analysis of what is the reasonable prospect of recovery and claim in the year of discovery the losses that the taxpayer knows that there is no reasonable prospect of recovery for. Now, when there is a reasonable prospect of recovery, those deductions are not going to be claimed until there is no longer a reasonable prospect of recovery. And the standard there is when it can be ascertained with a reasonable certainty that there's not going to be any recovery for any of the losses, then the losses can be claimed in that year. Now, now that the loss carrybacks are being eliminated, it's important for Ponzi scheme losses that could be deducted in prior years to be carefully studied. It is a fast process to receive tax refunds generally. As I said, you can file amended returns. Either you can take a deduction in a particular year and file amended returns if we are prior to the Trump tax bill. And the refunds that you can get will be as high as 37% for each dollar of loss going forward. And for losses that you're going to claim prior to 2018, you could have up to 39.6% plus the Obamacare tax, and also in many states where you pay state income taxes, you're going to be able to get a refund from your state income taxes. These refunds might have a little lower value going forward because of the reduced tax rates under the Trump tax bill. Now, though there are reduced tax rates and you cannot make use of the loss carrybacks, the other change is that you can continue to carry your losses forward as long as necessary, and there's no longer just a 20-year limitation until your recovery of losses going forward runs out. Now, it's critical if you have higher tax bracket losses prior to the year 2018 that you claim as much of those losses in the prior years as possible. This means for most taxpayers at this point, late in the game, that carryback refunds can be achieved for the years 2016, 2017, possibly 2015 for certain Ponzi losses. It's also critical to be able to substantiate the discovery of the fraud in a prior year to maximize the amount to be recovered. And this depends upon when the reasonable prospect of recovery no longer exists. Now, I described the revenue ruling, which defines the law. The revenue ruling says that a theft loss deduction defines the word theft for tax purposes, and it held that a Ponzi scheme was a theft loss, and it was a theft loss that resulted from a transaction entered into for profit. It's an ordinary loss, not a capital loss, so it's a very valuable loss if you're in high tax brackets. The ordinary loss ruling clarified the benefits of a business-oriented theft loss. The Ponzi scheme loss is an ordinary deduction for losses incurred in a transaction entered into for profit. The deduction is not subject to certain limitations on its use. It's not subject to the limits of the past, limits on personal deductions and the limits on itemized deductions. Again, on a going forward basis, a lot of this is not even the case anymore. The theft loss is deductible in the year the loss is discovered. However, the amount of the theft loss that might be deductible differs depending upon how much can be expected to be recovered going forward. Once a taxpayer has deducted all that they could reasonably believe should be deducted in the year of discovery, the taxpayer has to reduce those claims for anything that there might be a reasonable prospect of recovery. This is when you have situations where you have viable lawsuits, you have insurances, where you really do not know in the year of discovery exactly how much you're going to recover. In the Madoff case, my understanding is almost everything was recovered. So there will have been many people in the Madoff situation who wound up taking tax deductions only to find out that now these recoveries became taxable income because they had taken these deductions in the past. The taxpayer cannot deduct any more of his or her undeducted theft loss until the deduction can be, and this is the bywords, the deduction needs to be ascertained with a reasonable certainty. And that's a very high standard. So ascertained with a reasonable certainty means people may be waiting for quite a while until lawsuits are resolved and things like that to actually be able to take the full amount of their losses. I also want to point out to everybody, there is an article that I did attached here as one of the materials that goes into the Ponzi scheme in a lot more depth than we can do in this presentation, and that's going to be very helpful to anybody. It's in the BNA publication of February 2011. Now, the major principle in each one of the decisions when there's victims of a fraud who want to take the theft loss deduction in the year of discovery, they need to really separately consider their sources of recovery, because there is, if you really are going to, it looks like you're going to be able to recover a lot through lawsuits, through insurances, through whatever means, you're going to be limited in how much you actually can take as a theft loss in the year of discovery. We have to be very careful with that. The revenue ruling that I discussed spells out all of the basic principles. The ruling spells out how one can determine the amount of the theft loss. The ruling, which essentially is going to be principal that you have put in and not taken out and lost, and profits that you have reported as taxable profits and also not taken out and lost when the Ponzi scheme exploded. So we have the amount of the theft loss is important to take a look at. The year of the theft loss deduction. The amount of the theft loss deduction in the year that you discovered it, which, like I say, there may be a limitation to these amounts depending on what one believes they're going to recover in later years. If there is no recovery in later years, then in those later years, any tax deductions that were not taken, thinking that there would be reimbursements of losses, those tax losses can be taken in those later years. I just want to touch upon the Trump tax bill did away with several non-business types of theft losses. People need to know that you can't have something stolen from your house by a friend and claim a theft loss deduction on these things anymore. There has to be a theft loss that was involved with income-producing endeavors. What do we need to be doing to make sure we maximize our recoveries from Ponzi scheme theft losses? You need good records. You need to make good calculations. You need to be very careful on what think your sources of recovery are going to be, because to the extent you have sources of recovery, you may not be able to claim theft losses, and you'll have to put those theft losses off until you find out there was no recovery, or if there was a recovery, then it's a good thing you didn't take those things as losses. You have your best opportunity to claim the most losses in the year of discovery. And that's because in the year of discovery, the standard is you can try to arrive at your losses based upon a reasonable person's approach to this. In later years, After the initial year, for any losses that you have not claimed, the only amount of losses that you can claim are when you have discovered that those are losses for which there is not any reasonable prospect of recovery. And this can be a reasonable prospect of recovery, can be a wide open question. Losses that are not taken in the year of discovery are recoverable only with a reasonable certainty. Now, we've looked at the Ponzi scheme. We've looked at how much can be deducted, the losses that can be deducted, which is the amount of money you put in, the amount of money that you've paid taxes on, minus the amount of money that you took out. And that's going to be your basis for recovery. If you are not recovering the full amount in your early years, because you're ultimately, as the time unfolds and more, you either do receive reimbursements and are not entitled to take any more losses, or if you don't receive reimbursements, you are entitled to take additional losses, and ultimately you should be able to claim losses for 100% of what your losses were. Now, I can't predict what years that might all occur. There is that possibility to make sure that you can fully reclaim all of your theft losses. Now, I want to switch over and talk about the second Internal Revenue Service document that was called a revenue procedure. The revenue procedure has the term known as the safe harbor for Ponzi losses. Let me explain to you a little bit about what a safe harbor means. The Internal Revenue Service was getting overwhelmed because of Madoff. There were different theories being sent in. There was different losses being claimed. It was all over the place. Some people were claiming everything. People were taking half of it. I mean, the legal theories that were being used were not all in sync. And so the Internal Revenue Service did took a very intelligent approach to this. And you have this idea of safe harbors in several areas of the law. But this is what the safe harbor meant in the Ponzi scheme situation. The safe harbor required the Ponzi scheme victims to forego the opportunity to go out and separately file amended returns for years that were still open, and to say, well, it's now 2009. I know I lost everything, and I know it was lost 3 years prior to this, and I'm going to go back and I'm going to amend my returns, and I'm going to claim all I can. The safe harbor does not allow you to take that approach. If you're going to be in the safe harbor, you need to take a standardized approach, and the safe harbor is a very, very beneficial treatment. The safe harbor, basically, the IRS said, okay, how do we know pretty much how much people should be deducting? What's the year in which they should be claiming that they have a Ponzi scheme loss? Let's do away with all of the what-ifs. And that's what you do in the safe harbor. The IRS says, well, we know 95% of the people should be able to take 75% of their losses in the first year, because they're typically not going to recover that much. Or we know that they are liable to recover certain things in the first year. The safe harbor says we have a good handle on whether there's really a Ponzi scheme theft loss. In other words, what happened? In Madoff, it was clear. He was a thief. He was indicted quickly. He was punished quickly. There were no guesses there. So the IRS decided, well, if we really know for sure we have something that either looks, feels, thinks like a thief, we're going to say, if you can prove these certain things that show that you really do have a theft on your hands, if you can prove these certain things, which were all provable in Madoff, we're going to allow you to go ahead and take a certain amount of deductions in the year where we know there is proof that there was a theft. Then the IRS says, okay, what's the typical amount of deductions that somebody could take in a Madoff type situation if they had no other, if they weren't going to go out and sue anybody, they weren't going to try to take any other kind of recovery at all, they had no resources to go forward. We know that that person who's lost it all and has no recourse, we know that they've lost 95% of their money in that first year. If we have a thief, if we have somebody that has no opportunity to make a recovery, we're going to allow that person to take a 95% deduction for all of their Ponzi scheme losses, the principal they lost and the income that they lost that taxes were reported on that were not withdrawn. The Internal Revenue Service then knew, well, there's another category, and this is a category of people who are going to have insurance recoveries. They're going to be able to bring very good lawsuits against people who defrauded them, that were intermediaries who made a lot of money and who still have a lot of money, and we're going to recover this money. So the Internal Revenue said, okay, for people who have some recourse to come up with money from other sources, we're only going to allow them to deduct in the year of discovery 75% of their losses, not 95% of their losses. For people who are willing to say to the Internal Revenue Service, okay, I don't need to file anything else. I'm not going to file claims for 100%. I'm not going to fight with you. I'm willing to go into what's called the safe harbor. And so what the safe harbor does is it says, if you were defrauded by people who have a certain standard of wrongdoing, and I'm going to read what that standard of wrongdoing is. It's where you know for sure that, not for sure, but you know that you pretty much have a thief and a theft. If you've met that standard of wrongdoing, and you've met the standards of either not having any other sources of recovery or the standards of having some resources of recovery, we are going to let all of you take a very simple approach to getting your tax refund. We're going to have everybody standardized. The first standard is, how do we know what year you should take it in, and how do we know that we really for sure have a theft? Deciding whether there is a fraudulent arrangement, the standard is, if a lead figure was charged by an indictment or information that's not withdrawn or dismissed under state or federal law with the commission of a fraud, an embezzlement, or a similar crime, that if proven would meet the definition of theft for the purposes of the Internal Revenue Code, or the lead perpetrator was the subject of a state or federal criminal complaint that was not withdrawn, alleging the commission of a crime described by this revenue procedure, and the complaint alleged an admission by the lead figure or the execution of an affidavit by that person admitting the crime, or a receiver or a trustee was appointed with respect to the arrangement or of assets that were frozen, then the amounts that can be deducted are going to be fixed. If you have no reasonable prospect of recovery, we are going to allow you to claim a 95% deduction on all of your Ponzi scheme losses. If you have any possibility of a potential to recover from third parties, then we're going to allow you to take 75%. And ultimately, several years from now, when all of this thing has now history for each one of these different thefts, you will be able to claim the balance if you've taken 95% and there's still 5% and you never recovered the other 5%, you'll take the balance. If you have 75% and you've recovered 50% and you've taken a deduction for 75%, you're not only not going to be able to claim any more of a deduction, but you're actually going to have to make some repayments because you did not have as big a loss as you thought you had when you were claiming the 75% rule. That's the very simple safe harbor, which is the IRS's way and a very clever way of dealing with things to make sure that they were not totally cluttered up with thousands of people and billions of dollars having all kinds of different theories of recovery and times of recovery, instead having a uniform approach or that people can rely on. Now, I don't want to leave you thinking that you can have a Ponzi scheme loss and not have met the standard of the safe harbor, which requires you to have a kind of a proven fraud almost, or an almost proven fraudster. You don't need that, and you also don't need, if you're claiming a theft loss from an investment entered into for profit, you don't need the safe harbor to determine the limitations of exactly how much you can recover, because there's still the law. There's the safe harbor, which makes the law, clarifies it, makes it easy, seek a recovery, but there still is the law that governs people who enter into income-producing relationships and are defrauded. And there's a lot of those people that don't get to the level of being where the fraudsters are arrested and everybody knows that they can take 95% or 75%. So we have the law. And the law is, if you can prove to some degree that there was a theft and you were involved in income-producing activity which led to this theft, there are other ways besides the safe harbor to seek recovery, and that is relying on the law. And the law is, and this is what I typically like to do. I've had several cases where there were theft losses and they did not fit in the safe harbor. What I like to do there is, depending on the state, I will call a criminal lawyer in whatever state it's in And I'll ask the criminal lawyer to look at the facts of the theft. If it's a business theft, if it's pretty clear, a criminal lawyer is going to give us an opinion that, yes, you have a crime. It wasn't prosecuted, but it's a crime. And you lost money, and this is the kind of money you lost. Based on that, based strictly relying on the law, as stated in the revenue ruling, not the safe harbor revenue procedure, but the law stated in the ruling, there's several ways to achieve recoveries there. And what I have now put up on the screen for you is a little chart where I compare the safe harbor with what the law is. And I'll just go down it quickly. Ponzi scheme loss is a theft loss deductible as an ordinary loss. Yes, that's the safe harbor says that, and the law says that. Theft loss in a business setting is deductible as an ordinary loss. Next, the amount of the loss is the principal that's been invested and the phantom income, the income that you reported taxes on that never really existed. That's the total of your loss because you reported taxes on income and you lost principal that you had paid taxes on before you invested it somewhere along the line. Next item is the carryback of net operating losses, which also is similar. And for, like I said, for years now going forward, there's going to be not a carryback, but only a carry forward. The deduction will wind up being reduced by certain applicable percentages. The safe harbor defines its percentage. Under the law, the taxpayer has to establish these percentages and has to prove, for sure I've lost it all, I want to take 100%, or I know I have this outstanding that I may collect from, I know I have this lawsuit I may collect from, and I'm only going to claim X percent in this opening year. The next item that I pointed to here is who's the taxpayer? Now, when you have partnerships, which is very typical, when you have partnerships, taxpayers are partners, individual partners, the losses will pass through to the partnership. If it's a corporation, the loss is going to pass through to the corporation. This is pretty similar for the safe harbor or whether you're relying on the law. The revenue ruling has a defined year of discovery, and that was the year that the perpetrator was indicted, or several of those other items that I mentioned, to prove that they were wrongdoers. Under the law, you have to look at the case law, and sometimes it's not all that easy to determine what is the year of discovery. The amount of loss recognized in the year of discovery. The safe harbor, as we said, had specific percentages. The taxpayer who's not relying on the safe harbor, because there really was not a conviction of somebody, but we're going by a criminal lawyer's opinion that this would qualify as a theft. This has to rely on case law, and it can be all over the place on exactly how much you are allowed to take in the first year. Under the safe harbor, you are not permitted to file amended returns. Finally, we look at the administrative issue, and under the safe harbor, the taxpayer has administrative ease. There is a very simple form that needs to be filled out. There's some proofs that need to be sent with the form, and it usually will not go any further than that, and the IRS will process this. If you're going under the law, you have to prove that you have a theft. You have to prove your amounts of your theft, and you have some very increased audit potential. But if you don't fit in the safe harbor, you really don't have a choice. And if you have been the subject of a financial theft, there's no reason not to go forward and do what one needs to do, filing tax returns, claiming the theft loss, even without the safe harbor. Now, we're going to look at one more little aspect of the Ponzi scheme, tax recovery, because very often we have a situation where the taxpayer has passed away, where we have estates or trusts. I want to outline what are the procedures when we are involved with an estate or a trust as opposed to individual or corporate taxpayers. There's 3 rules to go by. If the theft occurred before the decedent died and it's discovered while the administration of the estate is still ongoing, the estate may claim the income tax deduction. If the theft occurs and is discovered during the estate administration, the estate may claim an income tax deduction for the estate or an estate tax deduction off of the estate tax. Now, I would say typically because of the significant increase in how much is not subject to the estate tax these days because of the estate tax exclusion, you're pretty much going to have, if there's an estate administration and there is no estate tax, the estate is going to claim the income tax deduction off of estate income. If the theft occurs and everything's been settled, the estate may not claim either an income tax deduction or an estate tax deduction. This is Richard Lehman. We're finished for today. Thank you for the time you spent, and appreciate your attention.